Hey everyone, welcome back to my channel. Today I wanted to discuss clever ways we can use dealer positioning data and VIX to play option spreads to take advantage of theta and volatility. I'll be covering some of the more basic strategies first, and then do a follow-up video in the future to cover some of the more complex types of spreads. Before we get started, I'll leave several discount codes for trading services I use in the description, including Sonar Labs, TradeView, and Elite Trader Funding. Lastly, if you enjoy this content, don't forget to like and subscribe to help me grow this channel. With all that being said, let's get right into it. So the first thing I want to talk about is how you find this data. So if you go to TradingView and you go to the options dashboard here, you can pull up SPY or any ticker that you're looking to trade. I'm just going to use SPY in this example. However, this does really work for anything. You could do this for Apple. You could do this for, one thing I like to do is find plays on TradingView and then go to the options dashboard and pull up this dealer positioning data. So if we scroll down here to the dealer Greeks build-up chart, this is where we want to get the bulk of our data from for how this thing is going to move in the upcoming week, to determine what type of spread we can use to take advantage of this. And the beauty of option spreads is that there's so many ways to make money and to minimize your risk. And I'm just going to cover a few of them here, but the goal of this is to really sort of get you thinking about clever ways to use this data. Now, by default, we're just looking at deltas, and it's going to show 1 day of future price change. However, for these option spreads, and I should mention that to do option spreads, you do need to do this on a margin account, and therefore you need to have over $25,000 in the account in order to day trade. Just something to keep in mind because of the pattern day trader rule. There's not really a way around that. If you're doing a cash account, you can't do option spreads. So therefore, because I'm assuming that, I mean, many of you probably do, but I'm assuming a lot of traders don't have that base 25,000. So we're going to look at weekly option spreads that we can use in this case. And then of course we can close them out early once we reach a certain level of profit threshold, which is something I highly recommend doing. Now, if we go down here and we adjust the parameters to 5 days and change that, we automatically see we have a 0.254 correlation, which is actually a really great correlation just looking at the delta Greeks. Now, the thing is, when you actually, this is extremely high correlation. Oftentimes when you're looking at statistics, you want around a 0.4 absolute value. It could be negative 0.4 or positive 0.4. I've talked about this stuff in another video, so I don't want to get too far into it here, and I'll leave a link for it. But anything over 0.2 or negative 0.2, absolute value of 0.2 essentially is going to be a great correlation. And we can see, we get an idea of price distribution in the upcoming 5 days, as well as volatility distribution. Now, this sort of volatility, where we're looking at the higher end of 3%, is pretty significant. That's a lot of volatility. So we want to look at option spreads that take advantage of volatility, and we want to stay away from option spreads that can just absolutely get wrecked by volatility. So we can see that we have the highest probability here of going negative 0.2 to negative 0.31 within the next 5 days. And these are the probabilities based on historical correlations. Now, we are looking at deltas from the dealer side. One thing that's interesting, and we want to make sure we look at all this data is if we look at call deltas from the institutional side. So basically the speculative trader side. The dealers are always hedging, which I've talked about in other videos. Again, I'll leave another description, but if we're looking at delta, gamma, beta, charm, we're essentially looking at hedge fund positioning, whereas if we're looking at net put deltas and net call deltas, we're looking at institutional positioning. And we can see that this changes the picture a bit. So we have a weaker correlation, still a very strong one. And we can see it actually looks like we're going to be moving positive. So the thing is, though, the volatility is still extremely high. And that's what you'll notice during these times of high volatility. And that's why it's very important to look at VIX. And I have VIX here, and we can see VIX is over 30. Traditionally, anything over 30 is extreme volatility. And if you've been paying attention the past week, so I'm filming this video on October 17th, 2022. The week prior, we had CPI data, and we had some insane moves, moving like 12 points on SPY each day. It's just been absolutely crazy. And I'll zoom this out so you can get an idea of what I'm referring to here. So we had CPI data, and we get this massive dump from 359 all the way down to 347, and then we came all the way back up. And this is all in the same day, mind you. So this, in the pre-market, we went from 362 to 348, and then closed the day at 367. So I don't ever recall, since I've been trading, seeing volatility this extreme, where we're getting this many points moving every day. And if you're looking at my screen here, this is the Sonar Labs indicator. It's a great indicator for spotting order blocks and fair value gaps, which I've done videos about. Highly recommend using it if you're day trading, but we're not going to really be using it here because we're looking at doing option spreads instead. But so we do always want to pay attention to VIX. And the rule of thumb is when VIX is above 30, and we're seeing this kind of volatility where the price distribution based on the Greeks you're selecting is sort of all over the place, right? There's not a clear indication, and the reality is we can get big swings back and forth. Now, personally, looking at dealer open interest in Vanna and Charm, so if we just look at Vanna here, we can see we have a ton of positive Vanna on October 21st, so this Friday, and we have a ton of positive dealer open interest expiring off. So basically, this means that bullish positions held by dealers are going to be expiring off after the 21st, which essentially means that, so those are bearish positions for customers. So basically, we're looking at the opposite here, which means this could lead to some sort of large rally. We also have Vanna playing a large factor here. So let's see what happens when we just select Vanna. We don't have the best correlation. Now, if we combine that with Vanna and dealer delta, we get a much better correlation here. And again, we can see the potential for about a 25% probability rally here. Again, the volatility means that the opposite could be true as well. But one thing's for certain is that we're in a volatile times. And the reason why I'm putting emphasis on this is because we want to stay away from theta spreads when things are volatile. Now, if things were less volatile, and we're looking at days where volatility is less than 1%, or the VIX is under, I would say, lower than 25 or lower than 20 in some cases, times where the market's very stable, that's when it's a good idea to start actually looking at theta spreads. And I'll talk about those briefly. We should probably talk about theta spreads first because they are a great way to make money. So if we scroll all the way back on VIX, we can see last time we had this was in August, and we had the VIX under 20, and the market was pretty stable. I mean, it was sort of choppy as well, which theta plays really thrive in. So how can we take advantage of making money from theta? Now, I'm going to pull up, I have two sites here, optionstrat.com and then Robinhood. I don't actually use Robinhood, but I will give them credit. Their interface for setting up option spread is really impressive. I wish more brokers had a UI like this. I think that's why so many people gravitate to Robinhood, despite some of the shadier things that I don't like about Robinhood, like payment for order flow and things like that. They do have a great UI, so I have to give them credit there. But let me show you what I mean by a theta spread. So let's say we had high conviction based on, now we don't have this sort of conviction. Let me emphasize this. Right now things are very volatile, so I do not recommend theta spreads. But let's say that things were less volatile. We were expecting small moves over the course of the week, and there was a high probability that we were going to move to the upside. One way we could take advantage of this is by doing a put credit spread. Now, in order to do that, what you want to do is we're going to sell. So let's say SPY's price is right around 370 like it is now, and we were expecting an upside move, and there was a high probability of that. We'd want to go a couple strikes under, because when we're doing a theta spread, the downside to this I'm going to show you a put credit spread, and the downside to this is that if it goes against you, the risk reward is horrible. Meaning you can get about 5 of these right and get 1 of these wrong and wipe out all your profits. So therefore, it's important, again, to not be doing this during volatile markets. And I'll show you a different strategy we can use to take advantage of volatile markets, which has actually been working phenomenally well. And if you did this strategy during pre-CPI data release or pre-FOMC minutes last week, you would have absolutely killed it. But before I get into that, this theta spread, I would essentially sell the 367 put, which right now would essentially mean I need collateral. I would need actually enough collateral to essentially buy SPY 100 shares of SPY at 367 if I just sold this put, assuming we went under 367. But since we don't have that kind of money, we're saying that this is a smaller account. What we can do is immediately buy the 366, which protects us. Now, what this essentially means is that we instantly get paid a credit of $43. So 43 cents times 100, we get paid this credit. And as long as SPY stays above 367 by the time that this spread expires on October 21st, we keep that full credit. Now, if SPY were to go down a little bit, so say we open up this credit and we collected our $43, and as SPY went down, you would see that this credit spread would actually increase in value, which would mean that you're actually down. It means you could have been paid a better credit if you had bought it later on as it went down. But this is the sort of thing where we're confident that it's moving up based on the dealer positioning data that we've looked at. And unfortunately, I don't have a way of showing you what a good time for that right now. But for all intents and purposes, let's say that the price distribution with a good correlation above 0.2 said that we had all the probabilities of moving higher look good, and the volatility was a lot lower, roughly 1%. Then opening the spread, we could be confident that it was going to ultimately close above 367, allowing us to collect this full credit at expiration. And oftentimes, what I like to do is if we do open this credit and we collect our $43, and as time goes on and SPY moves up in price and we get to like 372 or 373, and this credit spread diminishes in value, even if I still stand to make, I don't know, $5-10 by letting it just expire worthless, because that's what you can do with these theta spreads. Ultimately, you want them to expire worthless so you can collect your full premium. Instead, I like to go in and do the opposite and close it out. So essentially, you could click on that spread in order to close it. Since I'm selling the 367 and buying the 366, I would turn around and buy the 367 and sell the 366. That would close it out. Usually your broker lets you just click on the spread and say to close it out, and they handle that part for you. And even if I have to, so say I collected $43 and then I had to spend $10 to close it out, I still make $33 per spread, and I have the security of knowing that I've locked in my profits, and then I can go and look at the following week and set up the next spread. And so you can also do if it looked like it were moving down, instead of doing a put credit spread, you could turn around and do a call credit spread. And that would mean, say SPY is right at 370 and we thought it was going to continue moving down, we could sell a call at 372 and buy one at 373, collect our $34 per spread credit. And as long as SPY stayed below 372, by the time it expires or by the time we choose to close it out, we get to keep our credit. Now, let's say that starts going against you. Let's say as the week goes on, things have been flat and you've been collecting your credit, and then all of a sudden we have this call credit spread and SPY starts moving up. Well, as it starts, there's a couple things you can do. One, if you go to the dealer positioning dashboard, or you see VIX is increasing, so volatility is rising, one of the easiest things you can do is buy a call. So you can essentially, if we have this credit spread open, we can buy a call, say at 374, and essentially use that to hedge. So that way, let me just remove these here. As if it really goes against us, so we get into our max loss, which would basically be $100, then as long as it keeps moving up, ideally, the money we spent on buying this call would essentially act as a hedge, and we can make some profit. And you do have to play with this a little bit. Maybe you don't want to buy a 374 call. Maybe you feel confident that it's going to keep moving past that. You could buy a cheaper call and take advantage of a bigger move as things move up. But that's one way you could do it. Or you could just go and accept the loss early and close it out. But sometimes it will look like you're going to lose and then move back in profit for you. So that's why oftentimes leaving the spread open and buying a call or a put to hedge it will protect you. And then there's another thing you can do. If it's like a FOMC day, which usually happens on Wednesday, well, I wouldn't do this on a FOMC day because price just goes crazy after 2 p.m. But let's say it's a very flat period and you feel that looking at the dealer positioning, that SPY is going to close within a 1% range by the end of the week. And let's say, okay, I think SPY is going to close at 372 by the end of the week. You can actually go and wrap it in both sides and do an iron condor. So we could sell the 374 call, buy the 375, turn around and sell the 368 put and buy the 367. And you can see the profits here, where as long as it stays within that range, you can collect that full credit. And if you do have the potential of losing on one side, at which point you could hedge by buying an option like I just showed, and make some money off theta. But again, these only work in times in low volatility. If you try these during times of high volatility, you will absolutely get crushed. So what do we do in times of high volatility? Well, let's look at SPY pre-CPI. And actually, this is one thing I really enjoy doing myself. So going into CPI, now you can see this was Wednesday, October 12th. If we had did that condor I showed where we sold a 360 call and bought a 361, and then sold a 355 put and bought a 354, price stayed in between that the entire time. By the time it expired, we would have collected that credit on both sides, and you could have done a 0 DTE, assuming that you're okay with the pattern day trader rule. You do get 3 day trades in a 5-day period, so you could have used one of your day trades there and did a 0 DTE iron condor and really collected there. But that is very dangerous to do on a FOMC day, because sometimes price will chop around the whole day and then just rapidly start swinging back and forth at 2 p.m. So in that case, you could even consider just closing it out beforehand and do what I'm about to show you. So say we know CPI is the next day, and we don't know which way it's going to go, because if no one actually knows, it's gambling to assume you do know. I've never seen tools accurately predict it no matter what. I usually recommend people don't trade CPI, but there is a way you can successfully trade it, and it's with what I'm about to show you. So we know we're going to get a big move. Volatility is exceptionally high, shown by VIX. We look at the dealer positioning, and it looks like this, where volatility is just ramping up. And if we look at the various metrics, we can see, okay, we're expecting big moves this week. We know CPI usually leads to those big moves, and there's other times that lead for that. So what we can do is, before close on Wednesday, with CPI being on Thursday, there's 2 things you can do. One thing I like to do is called a long straddle. And also, if you go to option strat, you can actually pull this up and you can look at them here. So let's say, let's look at the straddles here. Here we go. We have straddle right here. And this will break down what it is. And there's a ton of strategies you can use. I highly recommend you look at these. Debit spreads, credit spreads are the very common ones. Same with straddles, what I'm about to show you. Butterflies are also phenomenal types of spreads. I want to do a video all about broken wing butterflies, which are fantastic, which can allow you to win on both sides oftentimes, as long as you get a move. It depends on how you structure your butterfly. For instance, like a call broken wing butterfly, you make profit whether price stays the same or makes a small move to the downside. You lose if it goes to the upside, and then you can do a put break broken wing, which is the opposite, which is a really nice strategy. And again, when you're looking at the price distribution probabilities, you can decide on broken wing butterflies based on what you're looking at this site. However, let me bring it back into focus here, and let's look at what's involved in this straddle. And it's very easy. You just basically buy a put and you buy a call. And you do have to play with this. So in this case, let's say SPY is closing right around 357. What we would do before CPI, I prefer to do these out of the money when I'm expecting big moves, which you could see would have absolutely worked incredibly well. So let's say I usually go about 5 to 7 points out of the money. So in this case, we would have, now the prices are very different. So let's do this. Let's pretend it was at 370 instead. What we would want to do is we want to buy a put about $5 to $7 out of the money. So just to keep it simple, I'll do $5 out of the money. And then also we're going to buy a call $5 out of the money. And again, that looks like this, where as long as price doesn't stay the same, as long as we get a nice move, we're going to make money. Now, what the reason being is because even though we lose on one side, you can see this call is going to lose if we go down. We're going to lose this 176. But as long as it goes down enough, so as long as we go down below 359 in this case, we're going to start making money. That put profit is going to vastly outweigh it. And then that's just based on price movement. The other thing we have to account for is we're going to get a big IV pump in that case, and you get these big moves that dramatically pump up the IV, and so Vega takes effect and helps pump that option price even more. So that means with SPY, and this is how you want to play, and a lot of people make this mistake. So going into the day in the pre-market, we have this big sell-off. And we would have opened up, so if we had bought a 350 put, we would have opened up around 348. And at this point, you want to immediately slide your stop, or to be on, you want to leave your call option, which is already at $0. You're already losing at your call option because your call option would have been purchased around 364, 365. So at this point, your put is in the money, and now it is a profitable position. And I do recommend giving around 3 to 4 days expiration, because we do want to make sure that theta isn't going to eat too much of that contract. You could even give it 2 weeks, but it really comes down to what you can afford. But just make sure that you account for the fact that theta the next day is also going to eat some of that contract price when it opens up. So you do want to give it a few extra days at least, so theta isn't as big of a hit. If you have it expiring within 1 to 2 days, theta obviously has a bigger impact. But as soon as you open up, you want to leave your call option where it's at. It's a losing position. You just want to let it be, right? We're counting on volatility to potentially bring that back. At this point, our put is in profit, and we do not want it to go out of profit. So we pick a point at which we're going to say, okay, if we open at 348, if it starts coming back above 350 or $350.50, I'm just going to close it out and just take my profit on that. So at that point, when it started pulling back, now the intent is when this opens, the higher likelihood is based on past CPIs, it's going to keep dropping. So we want to leave it open. We don't want to close it right away. We want to give some time for it to potentially move lower, but we also don't want to give back our profits. So that's why we set a stop loss. We're in profit, and therefore we want to make sure going into the next day we lock that profit in if it starts going against us. In this case, it actually did. In past CPI events, it has not, and it kept going down. And by the end of the day, that long straddle was like, I've seen them as high as 1,000% winners off of this, especially if you just let it keep running down, and until you get a market structure change, then you close it out. And usually you don't get a market structure change, and you just make insane gains. And if you gave enough time on the straddle and you leave it open for a week, oftentimes CPI just keeps dumping. However, we're at a point where SPY is already so low that there's a lot of institutional buyers here. So when they saw SPY at this price, they immediately start buying it up. So we close our put and we take our profits, and our call is at zero value because things have dropped so much. We just leave it on. There's no point in closing it. And at this point, these buyers step in and dramatically push up SPY to the point where not only did our call option become to a point where we could have broke even, well, that actually ends up being profitable as well because the volatility is so extreme. And if at this point, I would recommend closing it at the end of the day. You've actually won on both sides because of the extreme volatility. But you can see if you left it on and then you did the same thing, you slid your stop pretty tight at open, you could have made even more money, assuming that your theta didn't take too big of a toll, because we even had a few more points occur in the after hours in that call option, and at which point you just close it out and you're good to go. Now, when volatility is this extreme, you can actually continue to do that, where you open another long straddle and you let the losing side stay as is. You take profits on the profitable side, where you slide a stop to make sure you're locking it in, and then of course the next day it bounces back. And we've been getting this a lot during these volatile periods where we're getting these large swings back and forth. And so as long as you buy enough time on these long straddles going into these macroeconomic events, chances are your losing side will still come back and be profitable. And it's a great way to take advantage of this extreme volatility. And the fact of the matter is, even if the unprofitable side loses in this extreme volatility, the profitable side usually outweighs it. So long straddles are a fantastic strategy to easily take advantage of all of this volatility occurring, because we can be confident that one side is gonna outweigh the winning side is gonna outweigh the losing side. These do not work in times of low volatility, and that's where we want to think about those theta plays that I've already discussed. So hopefully that all makes sense. If you have any questions, feel free to ask me in the comments, and I appreciate you watching.